Good morning, Charlie Mattingly here with Leading Edge. And we just wanted to get a message out to all of our clients today and in the weeks going forward. We're going to start making a weekly message to our clients just to talk about what is going on in the market. Things are getting kind of ugly, and I say maybe they've been that way for a while because it's been an amazing couple of years. I was reading something this morning, an article that I like to read, blog post by Ben Carlson of A Wealth of Common Sense. And he made a mention this morning in the title of his article was, "It's okay to be confused right now." And there's a lot of moving parts in the economy, a lot of things that are going on that are hard to know what's going to happen in the next week, in the next month. But today I want to share with you three things. How do we have discipline in this market? How do we use the past to learn how to have discipline right now? That's the first one. And that's more of a behavioral, a discipline kind of thing. Number two, what are we doing as your advisory team? Investments, trades, what are we doing? What are we thinking for you? And number three, what can you do as an investor, as a saver, as a person that will be in retirement or is already in retirement? So first of all, from the article this morning, it's okay to be confused right now. At a Berkshire Hathaway meeting in 2021, Charlie Munger, who's a partner to Warren Buffett, said, "If you're not a little confused right now by what's going on, you don't understand it. We are in uncharted territory." So if somebody like that says it, then it's pretty amazing because we don't know exactly what the short-term ramifications are going to be to all that's going on in the world today. High inflation, higher interest rates, war in Russia and Ukraine. So what we have to do is then fall back on the things that we do know, and we have to fall back on discipline, and we have to fall back on things we've learned in the past. So let's go through that today. I want to share my screen with you and show you a couple things that we've found to be very interesting. And one of those is we like to learn from prior years. And we know that in 2014, in fact, I thought it was amazing. I started just kind of recording these headlines real time because it was scary. In fact, 2014 is a fascinating year because Russia annexed Crimea, which is in Ukraine. So that's when some of this started. But let's just take a real quick look, take a minute to look at the year of 2014 and how scary, and it's just a typical year. It's not different than any other. They're all this way. There's always a reason to be a little fearful. There's always a reason to want to get out of the markets or do something maybe irrational. This is how we started the year, January 24, 2014. Dow starts off terrible. The news headlines are scary, obviously, and then a correction looms. This is a couple weeks later. February, is the correction over? Obviously, there's confusion. One of the persons that could be considered very intelligent says 99.9% risk of crash in 2014. Well, what's a crash and how does it affect you and I? I don't know. And he doesn't either, but a headline sells, that's for sure. And it's enough to scare people right out of the markets. Again, how bad is it going to get? They talk about it again in April 2014. John Hussman says the bubble is beyond 1929 and 2007. Boy, that'll get your attention. This guy's a very intelligent person. He runs a mutual fund company and he's an economist. However, if we listen to that advice or follow that guidance on the headline, then we may have lost. We definitely would have lost. So it's a wild ride. You get the idea. This is the most dangerous market since 2008. So 30% market meltdown they're expecting. The next day, consumer confidence peaked. So you can see and you can get a feel for some of the confusion that's going on here. So what does it make us want to do? It makes us want to do something. And so what are our choices? Well, we can go buy investments that have high past performance, high rate of return in the past. What does that mean for us? Well, it doesn't mean anything. We never select investments based off of just past performance. Sure, it's a nice thing to have, but it's a very dangerous way to invest. And we call it investing in the rearview mirror because it's the truth. Past performance is no indication of future performance. It's not a reliable indicator of anything. So that's one thing that people tend to rely on is, hey, well, I'm just going to go and I'm leaving these investments I'm in right now, things are looking bad, I'm going to go buy or invest in something that's done well lately. That is also a poor way to react. Markets have rewarded discipline. You can see on the slide here, I'm not going to go through every one of these, but there is a lot of very serious things going on here. 9/11 terrorist attacks, Iraq war, two of them on here, in fact, subprime mortgage crisis. And if you take a step back, and sometimes we lose, as they say, the forest for the trees, but we're taking a step back here. We're looking at 40 years of data or more. And you can kind of see that markets have rewarded discipline. Now, some people might say, I don't have 40 years. Well, that's why we have a diversified portfolio. That's why we have stocks, bonds, international, global companies, because you're right. There are times, short periods of times, where the markets, whether that be the S&P or U.S. stocks, may do poorly. So what do? Let's transition into not getting caught up in emotions and our own behaviors and fear, and let's focus on what we can control. Our goal is to create an investment plan and a retirement plan. So please call us. We'll revisit that. Sometimes revisiting the basics of what our assumptions are. And a bad market is baked into those assumptions. High inflation, we can model that. We can take a look at it. We can review it. What do we expect happen in the future? So those are things we can do. We can plan for worst case scenarios. We can review why we're investing. And sometimes that helps to calm our nerves a little bit. So you can see the things on here that we can control. Diversifying broadly is what we talked about. Reducing expenses and turnover. That's a tax issue. Reducing the tax effects on our investments, and hopefully diversifying your tax income in retirement. That's going to help as well. But that's a non-investment kind of tactic, if you will. But having a plan is what we believe that we can do that would help. I'm going to transition over to a little bit of the more nuts and bolts. A lot of our clients say, what do you do as our investment advisor, financial planner in these situations? First, I'm going to talk a little bit about investing and what are the things as investors that we do. Well, first of all, we're very careful about reacting in these types of markets. Because again, as we started out, we don't know what the next month, week, even year might hold. But as the time horizon expands, like you saw in that picture, we start to become more confident of what we can expect going forward. We do not know what's going to happen in Russia and Ukraine. We don't know what Putin's going to do. So we have to plan for multiple scenarios. So how do we do that? Before we ever invest, or I should say, as we invest our clients' money, we assume that something bad is going to happen. There's no way to know exactly what it is, but we assume that we're going to have a market downturn, a market crash. The U.S. is going to perform poorly over the next several years. Any scenario is possible, in fact. So we have to have a diversified mix of investments. And you can see here in this graph that we have all kinds of different things. The large cap U.S. companies, they're made up of companies that are categorized as growth. Some are categorized as value, which means their price is lower possibly. And that's maybe an oversimplification, but for our time purposes. What about inflation protection, investment grade bonds? That has a meaning. And all of these are kind of like, I usually say, players on a baseball team. They have different skill sets. They perform different roles in different environments. Again, this is because we can't possibly predict what the next event might be in the world. But these investments behave differently in different types of markets. And that's one of the tools that we use. So what about different sectors? Now, we don't try to time sectors and buy healthcare and sell technology based on timing or anything like that. We don't believe that's profitable for our clients. But we do believe in having many different sectors really helps depending on what happens in the market. So you can see we have all kinds: financial services, real estate, energy, things that are categorized as industrials, technology, of course, and so on and so forth, utilities, healthcare, consumer, defensive. So what about the different styles? Like I talked earlier about, some are growth, some are called value. Believe it or not, some of the best performing investments in high inflationary environments are small companies that are considered value. So those are things we think about. Where do you own? Where are your investments across the world? We want to be in all the places that can provide value in the world. Different kind of bonds. We think about duration and the quality. This would be a credit quality of the bond. So those are technical things that we're not going to get into now, but we also look at what are the overall holdings. This shows you a reflection of some of the inflation protected securities that somebody might own. This is just an example. And you can see some of the stocks that are spread out through here as well. This is not all of them, but just a quick example of some of the holdings. So we look at all kinds of things. One of the things is, how do we know what provides real diversification? Well, there's a thing called correlation. And so if correlation is low, it means they don't move in lockstep. We want things to move differently. We want things to have low correlation so that one thing does poorly, another thing may do better. So that's kind of what we look at. And this is a graph, not going to go into details of that, but that's correlation. And that's something that we think about and look at. So those are the first 2 points. Watch out for our emotions. Watch out for reacting in the short term, because we don't know what the next week, month, and even 1 year can hold. But we have to maintain our discipline. And it's hard to do that when we see those headlines. Number 2, what are we doing as your advisors? What are we thinking about? How do we manage investments? And just to summarize, we don't react based off of headlines. We have a plan in place, and we believe is proactive and prepared for market downturns, because we know they're coming. We just don't know exactly how and when or what it might look like. As we started off the video, sometimes it's very confusing while you're in the middle of it. Number 3, what can you do as an investor, as a saver, as someone that's going to be retired soon? Well, it's a message that we revisit often. A strong personal balance sheet. I can't stress it enough. Pay down unproductive debt. Save up in your emergency savings. Maybe have a little more than you currently do, might bring you some comfort. Cash in the bank is something that's very hard to define as far as how much is enough, because sometimes more cash than we think we need brings us comfort, even though we feel like sometimes we're missing out. Maybe we should be in an interest-bearing account, or maybe we should be investing. But cash in the bank brings people comfort. We can't always explain it. I feel it, and I think you probably do too. Review your plan. Give us a call. We're happy to review it again. Back to the basics. Why are we investing the way we're investing? Why are you investing? What is your plan? What is your time horizon? What is baked into the assumptions in your plan? In other words, down markets are baked into these assumptions. And we've also accounted for things like higher inflation, lower investment returns that could be possible going forward. So review your plan, stick to your plan, focus on what you can control, go out and live your life, enjoy time with your family and friends, and we'll get through this. We're going to be talking more on a weekly basis about events, current events, the markets, what we're thinking, what we're trying to accomplish for you. And we appreciate your questions. We appreciate you reaching out, and we are grateful to serve you as our clients. Thank you very much.